Gabby, it's good to see you. Happy New Year.
Happy New Year. Thank you.
I know you're looking for some new themes, but I think your first theme really plays right into what we heard from the Fed minutes yesterday. This idea that they are standing pat. A little bit of dissension there, maybe between the people who want to make sure that there's not a recession because it hurts the low-income people versus the people who want to make sure that there's not high inflation because that hurts the low-income folks, too. Maybe there's some debate that's taking place, but the message is pretty clear that free money is gone.
Absolutely. And that's the first portfolio resolution here, is really make sure that your portfolio is engineered for that end of free money. I think in the very short term, first quarter of the year, we're still talking about, is it 25 or 50 basis points in February? What's the terminal rate? Is it 5% or above? And that really matters tactically. But I think longer term, the read-through is even when rate cuts do arrive, which we think is next year, we will have a period of interest rates above the neutral level. And we are not going back to ZIRP. We're not going back to zero interest rate policy.
What does that mean tactically? How do you change your portfolio as a result?
So I think both tactically and structurally, the most important read-through is that this means that we are in the old era of investing, where we have to focus much more on the knitting of investing, which is really looking at earnings, right? Is a company profitable? Does it have a path to profitability in the next 2-3 years? We've already seen the damage that can do, especially within the tech sector, when the answer is no. I think it really behooves us to look at valuations again, and specifically the value factor, not the value style, but the value factor. What price are we paying for that future profitability? And it really also means focusing again on risk reward. Are we being paid to take risk in equities and credit?
15 years since that's really been the case. The Fed has been the biggest player since the financial crisis.
Exactly. And I think that's why it takes some time to recondition investors in this new reality. So it's no longer the reality where it's buy on any dip. It's no longer the reality where we can just focus on a handful of companies or styles or sectors as the opportunity. It means it's really much more about alpha. It's much more about active management, not just beta. And the other thing I really wanted to mention is the second portfolio resolution, which is that you don't just have to take risk. And really one of the main themes for us is that it's back to bonds again.
And that's been a long time coming, too. The idea that you are looking at these things, not just treasuries, but corporate bonds, and that's a place you'd like to be again.
Exactly. And I think the reason why is we finally have real yields back to their average levels on a global level. So you're getting paid for the yields. You're getting paid to wait. And this is even without having to stretch into things like high yield and leverage loans, which we'd be extremely careful with. You can just focus on core bonds and find income, find recession protection, and find a good risk reward. I mean, if yields rise another 1 percentage points from here, which is not our base case, the ag would be down 1.5% total return. But if yields fall 1 percentage point, then the ag would be up nearly 11%.
That's big.
So it's very favorable risk reward.